Mortgage rates are changing. Your credit score is changing. Can you get a mortgage with a low credit score? Yes. All this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back with our favorite mortgage broker and all of the land, Mr. Dion Beg. How you doing, my man?
I'm great, Gary. It's been another busy week. Lots to talk about.
You know, I was talking with some other mortgage brokers as well. I was hosting an event the other day, and we had them online, and they said the same thing. And I'm curious, is that just, people coming to the end of the year and trying to get their ducks in a line and all that sort of stuff?
Yeah, I think, it's been the recent reduction in interest rates, plus, the fact that we're going into winter. And some of the sort of more savvy people understand that, and then you and I have spoken about this, that wintertime is actually a great time to be a buyer. Because, if you're a seller in wintertime, generally speaking, your house isn't going to look its best because of the weather. And if you're selling, it generally means you really need to sell. So we've got a lot of savvy buyers, some of whom have been actually advised by their parents, hey, go buy in winter because the sellers who are selling really need to sell. Yeah, exactly. Yeah. We've heard the whole real estate cycle. Most sellers want to sell in the spring so they can move in the summer. And if they have kids, then they can get their kids sorted out. Maybe it's at a new school for September, that type of thing. Not many families move throughout the rest of the school year. So if you are a buyer in today's market, that's just a little added negotiation. And if you're willing to do the thing that most people find uncomfortable or inconvenient, that's just true in life. If you're the person willing to do that, you're probably going to win more opportunities than the others, right?
Yeah. I always used to say to our buyers, you as a buyer, you're providing a solution to the seller's problem. It's just another way to look at it, right? Now, mind you both have to come to a mutual agreement at some point, obviously, but that's just a different way to look at things. There's always different ways to look at things. And I'm curious, Dion, and we were talking about this offline too. There's so many different things coming out at us in the news, and we're seeing, everything from, large corporations to perhaps having layoffs. And we're talking like maybe 1% of the workforce or sometimes more, things like that. And of course, that's going to affect you personally if you are, in that 1% type thing. I'm curious, though, what does that do, from this perspective? Maybe that organization or that company is trying to, obviously watch their expenses and things like that. Lenders, banks go through the exact same thing. How's that affecting the lenders market if they're having to lay off people as well?
Yeah. So look, the reduction in volume of transactions is clear. We're depending on who you listen to, we're maybe in a 20-year, precedent. We haven't seen this few transactions in the last 20 years or so. And that being the case, it just means that these larger companies who have built up a workforce may not have any work for them to do right now, just because the transaction volume is so low. So this week, the headline in the mortgage industry is one of the major alternative lenders, Equitable Bank, who has been probably the second largest player in the B lending space for many years. They've actually announced an intention to downsize their workforce by 8%, which is a significant number of layoffs. So we're talking about this bank understanding the volume that we were experiencing is no longer there, and we are just doing a mass layoff. So that's the front line in terms of, there's no mortgages to write, so they're laying off a whole bunch of people. And I'll also say that it's coupled, Gary, with the fact that in the world of lending, we have A lending, B lending, and private lending. We're now talking about a B lender, Equitable Bank. And when I used to speak with clients several years ago who were right on the edge in regards to their mortgage qualifying, I could always say to them, look, if we don't land with an A lender, we have B lending as a backup, okay? And that was always the case. But in recent years, with government regulation and guidelines coming in, the B lenders have had to apply more stringent underwriting. And so now I have to say to my clients, look, if we don't land with a major bank, we also may not land with a B lender. We might end up with a private lender. And so I feel like the B lenders who used to be the catch-all are no longer the catch-all. So this is a combination of government regulation making it harder to qualify, in addition to the reduction in just overall transaction volume. So there's a lot going on in sort of the B lending world right now.
I want to just jump down the road of private lending, and there's going to be a group of our listeners that understand what that means, and then there might be another group that doesn't, and they've never really chimed in or learned about that term. And we're not talking about like Jimmy Two Shoes around the corner, that type of private lending. Talk to us and maybe give us that high level view of what you're connected to private lenders and what that means to really borrowers and clients from even both sides of it, if you will, right?
Okay. So yeah, when we think of private lending, your mind might immediately go to sort of the dodgy loan shark type of character. And let's be honest, those people do exist in the world of private lending. But in the world of private lending that I mostly deal with, I'm dealing with a segment of company called a Mortgage Investment Corporation, or a MIC, M-I-C, MIC. And these mortgage investment corporations are basically an investment fund that you or me or anybody in Canada can invest into. And then that money sits with that company. And then that company's job is to then go and find mortgages for this money to be invested into. Okay. So there's a bunch of these types of lenders out there. So they're what I would call B adjacent, right? They're very close to B lending. But their focus with A and B lending, they look at three criteria: income, credit, and down payment. Okay. With private lending, they're mostly looking at down payment. Okay. They care less about income. They care less about credit. They just care about the asset and how much equity exists in that asset. And so the thing with any lender is they always think worst case. Worst case being, what if the borrower doesn't pay? Now, with private lending, all they care about is if the borrower doesn't pay, how quickly can we sell the asset and how quickly can we recover our funds? The A and B lenders, they think the same, but there are a few more other steps that are involved before they go to foreclosure and actually selling of that house, right? So when we go to private lenders, just be aware, easier to qualify, but also if you default, and again, Gary, we've talked about this. This is where the foreclosures are happening right now in the world of lending, where if you're with a private lender and you miss a payment, those private lenders are the ones who are quick to move in terms of getting their capital back.
Yeah, exactly. And it's important to understand too, is as you explained, the private lending and the mix side. If you are interested in that type of investing, that's a good way to get into lowering your money on mortgages, because your money gets spread across many different properties in a sense, as well as you're doing it with other people. On the flip side, there's also opportunities to invest singularly, in a sense, right? And that type of thing. Yep. Maybe we'll save that for another video call.
Sure.
That's because there's a lot of great opportunities for private first mortgage and second mortgages and things like that. And I think there's a lot of value there to both the borrower and the lender, obviously. And I know you help people do both. Okay. If you've got to work with a B lender, or we're now talking about private lenders, I'd love to know who that borrower profile is for. Who is that type of money or that lender? Who's that perfect for? Because there's so many different ways to look at it. You might be self-employed. You might have had to, maybe you're looking to consolidate debt. And I know we're going to talk about credit and that type of thing. Talk to us about that, Dion.
Okay. So the first thing I'll say is when we're going away from A lending to B and private, this conversation only starts if you have 20% down or 20% equity. Sometimes people think, oh, can I go to B or private with 5% down, 10% down? The answer, unfortunately, is no. Again, these lenders are very much focused on the equity in the asset. So if you've got more than 20% down, 20% equity, we can look at B or private. Why were we going to B or private? It's usually because you're weak in one or two of these criteria, which are you're weak in verifiable income, or you're weak in credit, or you're weak in both. Okay, so let's say we've got a client A perfect example, I've got a client, he's a plumber, he makes well over 200K a year, but he does a lot of cash jobs, and on his on his tax return, his accountant's able to write down a bunch of expenses, and he only shows 20 or 30 grand a year as income. Okay, major banks won't be able to help that person. But with the other types of lenders, the B lenders will actually look at the bank account history, and they'll look at the fact that, okay, every month this person deposits $20,000 a month into their bank account. And so they'll see, $240,000 of annual income in the bank account, even though the income on the tax return is, say, $30,000. And they'll actually defer to the bank account income over the tax return income. So that's where the B lenders come in. We've got lots of clients who are in that category. Now, the other big reason is the credit. So let's spend a minute talking about credit. In the last week in particular, actually, I've had several clients who have raised some credit questions. Well, actually, let me ask you, Gary, what do you think a good credit score is in today's world?
I'm going to say anything over 700, you're probably sitting quite well.
Yes.
Okay, good.
Yep. I think you're right. So a lot of people come to us thinking, some extremes. They think, I need a credit score of 850. Understanding, just so everybody knows, the credit score goes from 300 to 900, okay? And almost nobody has a 900, and I've never seen anything really below 400, okay? So, but major banks are looking for a magical number. That number is 680, okay? So closer to the 700 number. Now, at 680,000, effectively every lender is happy to lend to you. Also, if you're getting an insured mortgage, it unlocks a little bit more of debt coverage, meaning that you can actually borrow a little bit more once your credit score is above 680. If it's below 680, you certainly can still borrow, but you may not be able to get as much. I will tell you, again, with major bank lending and A lending and insured lending, if your credit score is anywhere below 650, it's going to be a little bit of a challenge, okay? It can still be done, but certainly below 600, you're not dealing with major banks, you're not dealing with A lending or insured mortgages, okay? So when we're going to B lending, they don't really care so much about the credit. Let me clarify. They do care. Some of them have cutoffs at, say, 500 or 550, and they will scale your interest rate based on the credit. Okay, so let's say your credit's not perfect, but you've got a score of, say, 640, then you'll get a better interest rate than somebody who has a credit score of 500. Okay, you'll probably still get funded the same amount, but the interest rate might be slightly different.
I'm curious on that, Dion. Does every lender look at that 640 versus 600 and have that same ladder of what that interest rate would be, or is it more of how that the underwriter being the person who analyzes the actual mortgage application?
It's a good question. In fact, the lenders do have guidelines right around this, and they will have hard cutoffs. So they might put 650, 600, 550 as these cutoffs. And sometimes as brokers we can argue that, okay, look, my client's at 558. Could we please get them the 600 rate? And we can sometimes make an argument for that. But yeah, it's good with the B lenders. It's pretty much black and white based on certain cutoffs.
Gotcha. Okay, so I know the follow-up question should be if I've got a lower credit rating, how does one improve that? Can it happen overnight? Does it take time? What do we need to do?
Right. Yeah, it's a combination of number of facilities, how well you use them, and how long you've had them. They're the big ones if I was just to simplify the credit report. Okay, so I'll give you some examples. Let's say a guy comes to me, he's only got one credit card with a $500 limit, and he only got it 3 months ago. Okay, so as much as they've done the right thing, unfortunately, the amount of credit is low, the length of time is low, right? And let's say he was told that he needs to use his credit card, and so what he's doing every month is he's running his credit card all the way up to the $500 limit, like $490 a month, okay? And he's thinking he's doing the right thing. So unfortunately, that's going to work against him because he's using nearly 100% of his available credit every month. So for this person, their credit score is not going to be great. Okay. Now, let's say that we were lucky enough to meet that person 3 years ago, and I spoke to them and I said, here's what you need to do to create a better credit score. Okay. So the advice I would have told him 3 years ago would be, don't just get the one credit card, go and get 2 or ideally 3 facilities. Okay. Some of those in the short term, you might actually have to give a security deposit to get, especially if you have skinny credit. In fact, when I moved to Canada from Australia, I had no credit history. I gave $5,000 to TD and they gave me a $5,000 credit card. Okay. This is also very important, guys. We need a credit card that actually reports to the credit bureau. Okay. So sometimes, depending on the way it's sold to you, they'll say, oh, give us the $5,000 and you'll get a $5,000 credit card, but it doesn't report to the credit bureau. So if you're going to do this, make sure you get one that does in fact report to the credit bureau. Okay. So let's say we spoke to him 3 years ago. He went and got a couple of credit cards, and let's just say they're at, say, $5,000 each. So this person now has $15,000. Some people might say, well, Dion, before we had a $500 limit, isn't that good enough? And isn't the fact that it's low a good thing? Surprisingly, the answer is no. Okay. The higher your limits, the better your credit score will generally be. And it comes down to this thing called utilization. So here's what I mean. Let's say that this guy consistently uses credit to $490 every month. Okay. $490. If he's using that on a $500 limit card, he's at nearly 100% utilization. If instead he's using that $490 on a $5,000 limit credit card, he's now using 10% of his available capacity. And that person, even though they're using the exact same amount of credit, the person with a higher limit is going to have a better credit score. Okay. So if you're out there, and in fact, this week I had some clients who were really excited because we refinanced them and they were able to pay down their credit cards. And I was like, Dion, we're going to close all these cards. And I said to them, don't do that. Okay. Because also the number of cards you have also helps you build the credit. So again, if you've got 3 credit cards and you end up using just the one at $500 a month each, it shows you I've got $15,000 capacity. I'm using only 500 of that. And banks love giving money to people who don't need money, right? So this is a way you demonstrate that. So leave your facilities open as long as they don't cost you money. Make sure you stay on top of your payments and don't reduce your limits. And if the bank calls you and says, hey, you've qualified for an increase on your credit limit, again, parental wisdom will say, don't do that. But, tactical understanding of credit and how it's important, I would say to you, as long as you're not going to go and be silly and use your credit card all the way to the limit, take the credit limit increase because that'll help you build the score.
Excellent. My kind of last question around that is where does the credit score come from? Who calculates that? And we kind of understand how it's calculated now to some degree, but is there a way to, check in and verify my own credit score?
Yeah, so the 2 major reporting agencies that we use in Canada are Equifax and TransUnion. Okay, now each of those institutions have reports that you can subscribe to. You can pay those major institutions to get access to your credit report and I guess credit monitoring as well. Okay, so many of our clients use the services of the 2 big reporting agencies. I also need to let you know that there's 2 versions of your report. There is the public report that you get, and there's the institutional-facing lender report that we get. And sometimes they don't exactly match. Like I could pull credit on the same day that you do, and your score might be slightly different to ours. It's never by a tremendous amount, but some people are sometimes confused by that. And separate to those 2 major reporting agencies, I believe, there's a couple of other third-party private companies that some of our clients use. I think, Gary, you were talking that some of your clients also use just to monitor their score to make sure that, especially also, they're not being sort of taken advantage of with fraud. Yeah,
and that's a big piece of it. There are companies out there, and one that I even personally use, and I can't remember the name of it at the top of my head, and I apologize. But yeah, it obviously monitors the credit score. Maybe more importantly than that, though, it monitors potential fraud, everything from using your social insurance number to many, many other things. And that might be a benefit to some that are, would like that extra protection from the fraud perspective. And when you pay into some of these on a monthly basis, there is some insurance piece that comes with that as well. Not only peace of mind, but from a monetary piece. Okay, this is good stuff, Dion. And what I like about it is there are opportunities. Should you have a lower credit score, there are opportunities to still get financing. There's obviously a path to bettering that credit score for you and your future, Dion. Maybe there's a good way to kind of sum all this up. Should one have a low credit score? What are the 3 things they should be doing right away to help their future? Whether it's buying, maybe they need to buy a new car, to buying a new house. What is there something that they could be doing right away?
Okay, so first thing is just to become disciplined, right? Yeah. So that is understand what your limits are and make that promise to yourself that you're going to never get anywhere near your limit. Okay, so that's the one thing. The other thing is if you're planning on buying a property this year, now may not be the time to go out and go and get 4 or 5 credit cards, because in the short term, your credit does get negatively impacted. So before you take any drastic measures there, talk to a mortgage professional who can guide you there. But if you're not planning on buying a property for 6+ months from now, then it might be wise to go and secure some extra credit if your credit is skinny, and then use it well and build. Okay, so because the more you have, the better it will be. And if you're not planning on buying for more than a year, now is the time to go nuts. And when I say go nuts, go and get 3 or 4 facilities. They don't have to be credit cards. They could be lines of credit as well. Interestingly, student loans don't really help us in any significant way. Vehicle loans do help, but they're not as good as unsecured credit, which is just pure line of credit or credit card. So if you have your choice here, it's go and get a couple of credit cards or a couple of lines of credit.
Excellent. Okay, next video, then we're going to tee this up. Next video, we're going to talk about things not to do with your credit cards or your loan applications while you're in the process of buying a home. We're going to talk about that because there's some curveballs that you can do to yourself that really factor in the closing of the home. My friend, how do people get a hold of you?
Yeah, at kangamortgage.ca or Instagram at Dion Beg.
There you have it, my friends. That's Dion Beg. Of course, I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.